When it comes to raising capital for a business, the decisions you make are not just about securing funds. They also involve long-term strategic considerations that can impact your business's structure, growth, and financial health. Accessing capital isn't a one-time transaction. It's a decision that can shape your company's direction and influence its ability to compete in the marketplace. Whether it's choosing between debt and equity, deciding when to issue shares, or considering the risks involved in venture capital, each choice comes with significant implications. This can be done through private investors, venture capital, or public offerings such as IPOs. The cost of capital is essentially the price a business pays for accessing external funds, whether through debt or equity. Deciding when to raise capital can have a significant impact on the terms of the financing and the amount of control the business retains. Debt financing, while attractive due to its tax advantages and the retention of control, can strain the company's balance sheet. When raising capital, businesses must adhere to various regulations, whether they are in the form of securities laws, tax codes, or industry-specific guidelines. For instance, when issuing shares to the public, a company must comply with regulations set forth by bodies such as the securities. Whether raising capital through debt, equity, or other financing methods, business owners must weigh the implications of their choices, considering factors such as the cost of capital, the timing of financing, the business's financial health, and its long-term goals. Strategic capital raising decisions can help businesses build a strong financial foundation, reduce risks, and position themselves for sustainable growth and success. An exchange commission, SEC, in the U.S., or similar regulatory bodies in other countries. These regulations ensure transparency and protect investors, but they also come with costs and obligations. Companies seeking to go public must provide detailed disclosures, undergo audits, and comply with ongoing reporting requirements. These regulations can increase the cost and complexity of capital raising, but are necessary for ensuring a fair and stable financial market. If the company does not manage the debt well, it could face a higher risk of financial distress or even bankruptcy. Early on, businesses may rely heavily on equity financing, particularly if they are in high-growth sectors or facing significant risks. As businesses mature and become more profitable, they may shift towards debt financing, as they can handle the repayment obligations and benefit from the lower cost of debt. In this stage, companies may also explore options like retaining earnings or issuing new equity to fund their operations, rather than relying solely on external financing. The ability to adapt to changing capital needs is crucial, as businesses need to be flexible and responsive to market conditions and internal growth strategies. For businesses using equity financing, while there is no obligation to repay the capital, the cost lies in the dilution of control and the potential need to adhere to the investor's preferences. Both debt and equity financing are trade-offs, and the long-term impact should be carefully considered in light of the company's goals. Raising capital too early can mean giving up equity or taking on debt when the business is not yet in a strong position to meet the financial obligations. On the other hand, delaying capital raising until the business is struggling with cash flow or facing competition can result in worse terms, as lenders or investors may take advantage of the company's weaker position. Timing also plays a crucial role in deciding whether to go for an IPO, issue bonds, or seek private investors. For instance, the stock market's condition can greatly influence the price at which shares are offered during an IPO. If the market is down, the company might have to offer shares at a lower price than it would during a more favorable market environment, leading to more dilution and less capital raised. For debt, the cost is the interest rate that the business must pay on the borrowed funds, while for equity, the cost is the dilution of ownership and the expectations of investors in terms of returns. The cost of capital should be carefully evaluated, as it can affect the long-term profitability of the business. For instance, a business with a high cost of capital may find it more difficult to generate returns that exceed the cost of financing, ultimately affecting its ability to grow and compete. Businesses with stable cash flows and lower risks tend to have a lower cost of debt, while startups or high-risk businesses often face higher equity costs due to the inherent risks involved in investing in these companies. The major advantage of equity financing is that it does not require the company to make regular payments like debt financing. Instead, investors typically expect a return on their investment through capital gains or dividends. However, This comes at the cost of ownership and control. When business owners sell equity, they give up a portion of their decision-making power, and this can dilute their ability to steer the company in the direction they desire. In addition, equity investors may demand a say in major business decisions, or they may want to exit the business once it reaches a certain size or value. For startups or high-growth businesses, equity financing through venture capital can also bring valuable expertise networks and guidance, but it can also lead to conflicts if the investors' interests don't align with the company's long-term vision. One of the first strategic considerations for businesses is deciding how much capital is needed. A common mistake that many business owners make is either underestimating or overestimating their capital requirements. Businesses typically have two main options: debt or equity financing. Both come with their own set of strategic implications. Debt financing, which includes options such as loans or bonds, provides capital in exchange for the promise to repay with interest. The advantage of debt is that it allows business owners to retain full control over the company since the lender or bondholder does not gain any ownership rights. However, the main downside is the financial obligation to repay the debt, regardless of the company's performance. This can be particularly risky if cash flows are unpredictable or if the business does not generate enough profit to cover debt repayments. Additionally, debt financing can lead to higher financial leverage, which increases the risk of default if the business faces a downer. Underestimating the amount of capital needed can result in running out of funds before achieving business goals, leading to cash flow problems, missed opportunities, or even the collapse of the business. On the other hand, overestimating the capital requirement can lead to inefficient use of resources, excessive debt, or dilution of ownership for equity-based financing. Therefore, accurately assessing the capital requirements for expansion, R&D, marketing, or day-to-day operations is crucial. This assessment often involves a deep dive into financial forecasts, understanding the costs of running the business, and factoring in both short-term and long-term needs. Once the capital requirements are determined, the next consideration is how to finance these needs. On the other hand, equity financing involves selling a stake in the business in exchange for capital. A key consideration in choosing between debt and equity is the cost of capital. Another strategic consideration is the timing of capital raising. Furthermore, the company must also consider the long-term impact of capital raising. Another important aspect is the regulatory environment in which the business operates. As businesses grow and evolve, their capital needs may change. In conclusion, accessing capital is not just about securing funds. It's about making the right choices that will support the business's growth, strategy, and long-term success.